Most people think investing is about picking the next Apple or Tesla. But what if I told you the world's wealthiest investors don't even try to pick winners? Instead, they use a cheat code called an ETF. You've seen the term everywhere, from TikTok to Wall Street, but most people actually get it wrong. So, what is an ETF, and why is everyone suddenly obsessed with it? Well, let's pull back the curtain and break it down in the simplest way possible. Because ETFs are one of those things that sound complicated at first, but once you understand them, you kind of wonder why nobody explained it like this earlier. Now, the name itself, it's a bit of a mouthful. ETF stands for Exchange Traded Fund. And I know, that already sounds like something that requires a suit and tie, but the idea behind it is actually incredibly simple. An ETF is basically a basket. That's it, a basket. Think of it like this. Instead of buying one single stock like one company, you are buying a collection of many different stocks all at once. It's like going to the supermarket. Instead of picking one apple, you buy a pre-made fruit basket that already contains apples, bananas, oranges, and maybe even a bit of acai. You know, that one thing you can't pronounce but looks incredibly healthy and expensive. Well, that's exactly how an ETF works, but with investments. And just like those fruit baskets, these financial baskets have evolved. In 2026, they can hold much more than just stocks. Some ETFs are designed for convenience. Take a Bitcoin or a gold ETF, for example. These let you own those specific assets through your regular bank account without the headache of owning a physical gold bar or managing a complex digital crypto wallet. It's about making a single, difficult asset easy to buy. But the most famous type of ETF is designed for diversification. This is where you buy a basket that contains hundreds of different stocks, like Apple, Microsoft, and Tesla, all in one go. So instead of putting all your money into one company and hoping it does well, you spread your investment across many companies instantly. And this is where things start to get interesting, because that one simple idea solves one of the biggest problems in investing: putting all your eggs in one basket. If you invest all your money in just one company and something goes wrong, that's a big problem. The kind of problem where you suddenly stop checking your banking app and start checking your horoscope instead, hoping the stars will align to bring your money back from the dead. But with a diversified ETF, if one part of the basket performs badly, the others can balance it out. It's like ordering a pizza with multiple toppings. If one topping is terrible, you don't throw away the whole pizza. You just quietly avoid that section and pretend it never existed. But the safety of the basket is only half the story. The other half is how incredibly easy they are to actually buy. You see, another important part of ETFs is in the name itself: exchange traded. This simply means you can buy and sell ETFs on the stock market, just like regular stocks, so they're easy to access. You don't need to be a professional investor or have some secret Wall Street connection. If you can buy a stock, you can buy an ETF. And that simplicity is one of the reasons why they've become so popular. But popularity is one thing, performance is another. Is it actually a smart move, or is this just one of those things people repeat because everyone else is saying it? Well, it all comes down to one word: simplicity. The main reason ETFs are so popular is that they make investing incredibly easy. Instead of researching dozens of companies, reading financial reports, and trying to figure out which one will perform best, you can just buy a broad ETF and instantly own a piece of many companies. It's basically the difference between buying a pre-built sofa and trying to assemble one yourself from a giant IKEA box with 400 pieces and a confusing manual. But it's not just about saving you a headache, it's also about saving you money. You see, ETFs are known for being incredibly low cost. Many ETFs have very low fees compared to actively managed funds, where professionals are constantly buying and selling investments, trying to outperform the market. And here's the funny part. In many cases, those professionals don't consistently outperform the market over long periods, So people started thinking, why am I paying higher fees for something that might not even do better? That's where ETFs came in and said, what if we just follow the market instead? No trying to outsmart it, no dramatic moves, just follow. It sounds almost too simple, but over time, that strategy has proven to be surprisingly effective. But the benefits aren't just in your bank account, they're also in your head. You see, there's a massive psychological advantage to this approach. Investing in individual stocks can feel like a roller coaster. One day, everything is up. The next day, everything is down. And suddenly, you're checking your portfolio more often than your Tinder messages. ETFs tend to smooth that experience out a bit. They're still affected by market movements, but because they're diversified, the ups and downs are usually less extreme compared to single stocks. So instead of a dramatic roller coaster, it's more like a slow scenic boat ride with a life jacket and a very cautious captain. It's definitely not as exciting, but it's also way less likely to make you scream for your mom in the middle of a Tuesday afternoon. And if you want to keep that heart rate low while building your wealth, you're in the right place. If you're finding this helpful and want to master your finances without the headache, make sure to like this video and subscribe to the channel. It really helps the channel out, and it keeps you in the loop for more simple financial breakdowns. But look, I know what you're thinking. If ETFs are this easy, this cheap, and this safe, why isn't everyone invested in them all the time? Is there a catch? Well, to be fair, there are a few things to keep in mind before you dive in. For starters, remember that diversified doesn't mean bulletproof. Since ETFs follow the market, they go wherever the market goes. If the whole stock market takes a dive, your ETF is going down with it. It's a basket of stocks, not a magical shield that ignores gravity. And another thing, if you're looking for a get-rich-quick scheme, this isn't it. ETFs are built for the long haul, not for doubling your money by tomorrow morning. If your investment doubles by tomorrow morning, you're not in an ETF. You're probably buying a digital coin named Cyber Squirrel. It's all fun and games until the squirrel decides to hibernate, and suddenly you're staring at a screen wondering where your life savings went. The truth is, real wealth isn't built in a frantic weekend. It's built in decades. That's why ETFs are more about the long game. They're like rolling a snowball down a mountain. At first, it's just a sad, tiny ball of slush that looks like it's going nowhere. You're doing all the work, pushing it along, and the mountain goats are probably looking at you like you've lost your mind. But then, the momentum kicks in. It starts picking up snow, and eventually, it's a giant, unstoppable boulder that's flattening everything in its path. And that brings us to the final question. Are ETFs actually worth it? The honest answer is, it depends on what you're looking for. If you enjoy analyzing companies, reading financial statements, and trying to pick the next big winner, then ETFs might feel a bit boring. They don't offer that same level of excitement or control. But if you're someone who wants a simple, efficient, and relatively low-effort way to invest over the long term, ETFs can be a very powerful tool. They allow you to participate in the growth of the overall market without needing to constantly make decisions or guess what will happen next. And for many people, that's exactly what makes them so valuable.